Shifting back to the markets today, and the markets did trend and close on the lows. The U.S. unemployment rate, of course, if we just look back to Friday, actually fell to a 50-year low in September. And while so many economists hope that the U.S. consumer on the back of this will help to offset the weakness that we've seen in the economic data, specifically manufacturing in the United States, our next guest says, don't bet on the consumer holding it together for the overall economy. For more, we're now joined by one of Wall Street's top economists, famed investor Gary Shilling, president of Gary Shilling and Company. Gary, so nice to see you in our studio. Thank you.
Glad to be here again, once again, Catherine.
Once again, and there's so much to discuss, but let's start with this, because it is interesting, and it's very different versus what most people are reading on that 50-year low on the unemployment rate.
Yeah, the facts are, if you look at the 11 post-war recessions we've had in the U.S., the average lag between the peak in business and the low in the unemployment rate is 17 months.
Okay.
In other words, the unemployment rate could continue to decline even though you're in a recession, because it's a lag. It's a lag of 17 months on average, so it doesn't tell you much. They're delayed reactions. You don't get layoffs and so on and so forth until business really gets weak. A lot of things that don't affect employment that don't happen until the recession is well underway.
So does that mean then that you do believe that business peaked 17 months ago? Around then?
Well, you know, we don't know if the unemployment rate has hit its low.
Right.
But I think we probably are in or very close to recession. When you look at all the indicators, the inverted yield curve, the weakness in capital spending, you look at transportation stocks, which have declined versus industrials. That's normally a sign of a peak. There are a lot of other indications there. The Cleveland and New York Federal Reserve banks, their recession indicators are in negative territories. The OECD indicator of 32 leading countries, U.S., Canada, Europe, et cetera, that's in negative territory. There's a lot of signs that the economy is weak. And the thing is, you don't get the data instantly. There are delays in reporting and also revisions. And revisions at the top of the economy tend to be down. Just at the bottom, they tend to be up. So it's later. I mean, for example, the guys who officially call recessions, called the National Bureau of Economic Research, private organization. No president in the United States would ever want to call a recession. No, no, no. But this group studied them since the 1930s. They didn't until December of 2008 say that the recession has started in December of 2007. That was the Great Recession. A lot of times they don't get around to making a call that you've hit the top until the recession is over. So, you know, it's I like to say, Catherine, when it's obvious it's over.
Right.
When you see everything clearly, hey, the markets have discounted it. You got to peer into the darkness and read the tea leaves and use the judgment and Kentucky windage and a lot of other factors.
And to you then, you are seeing enough signs to say I'm taking risk off the table to the point where you're actually, when you look at the S&P 500, are you looking to short it? Yeah,
we are short the S&P 500. We've only done that in the last couple of weeks. We've had a defensive position in stocks, small defensive position in our portfolios we manage in utilities and consumer staples, things that people tend to buy regardless. But we've been long Treasuries, which is my long-term favorite, as you know, long the dollar. I think there's a rush for the dollar as a safe haven. And commodities, I think commodity prices, you know, you get global excess supply exceeding demand, worldwide slowdown, and commodity prices invariably go down.
And to remind our viewers, you haven't been short the S&P 500 since prior to the financial crisis, 2007,
That's correct? That's correct.
So what is it now that caused you to put this trade on only a couple of weeks ago?
Well, just a conviction that the tea leaves and the forecasts and the hunches and everything else were pointing to a recession, and also the market action. You know, markets can remain irrational a lot longer than I can remain solvent. So you got to pay attention to what's going on. But if you look at the U.S. S&P, it really has been going. It's really topped out last year, early last year. As a matter of fact, it's nowhere. It's essentially where it was a year ago. Had a big sell-off in the fourth quarter, some revival, but it's going nowhere in the last year. And when you get that broad top like that, it usually tells you that the game is over. So there were a number of things, but it just seemed to me that the time was come to take a swing on the downside.
That's a big swing to go short the S&P 500, particularly when you have a Fed that looks to be wanting to add stimulus, monetary policy stimulus to the market. We heard from him on that front today. And then also, of course, where we have a president that seems to give a bit of a floor to the S&P as well. How do you go short?
Well, bear in mind that the Fed usually is patriotically easing at the end of a business cycle or soon after the recession starts. They see that the economy is weakening and they switch from tightness to ease. So they're right on schedule. But that doesn't prevent recession because the job is already done. There are lags, the effectiveness in monetary policy. There's also the reality that when you get into recession, nobody wants to borrow, and the investment opportunities there, capital investment, et cetera, are not there. And so having money around from the Fed doesn't do much. As a matter of fact, the Fed has been flooding the world with money ever since quantitative easing followed the big decline in interest rates after the Great Recession. So it isn't this the instant. Now, a lot of people have felt that. You know, it's interesting. We've had times when weak economic reports lead to rally in stocks. Why? Because people say, well, that means the Fed is going to ease.
Exactly.
And all they do is pay attention to the Fed. And the Fed was a driver of U.S. markets, I'm convinced, from March of 2009 when you saw the revival of stocks. And so the story was all you need to do is pay attention to the Fed. But it's not what the Fed does, it's why the Fed does it. The Fed is easing because they're worried about the economy. Then you got to worry. Then you got to think about the economy and what it does to earnings and general spending and economic conditions. And the Fed does not really matter for a number of quarters.
Gary, the bulls would say, though, that the move that we've seen, the lack of move that we've seen in the S&P 500 over the past year, is the market just consolidation, and that's healthy in a bull market. They would say that, and then they would also say that with the Fed moves in stimulating the economy, that's kind of worked for the past 10 years. It'll continue to work.
Well, yeah, but the point is that what do you do for an encore now? The Fed they've been dumping money out of helicopters. There's not much you can do. You've got the rest of the world, which is pretty much in recession, particularly in Europe, Germany, and also the effects of stimulus at this point. It's pretty much you've played out the game. So I don't think the Fed is going to. I don't think the Fed can really pull this one out of the ground. You know, they certainly would like to, but I don't think I think the die is cast.
Do you think Trump can?
Pardon me?
Do you think Trump can pull it out once again?
Well, I do think that if I'm right that we are in a recession and a global one, U.S., Canada, Europe, Japan, that there will be a fiscal policy response, and that will probably be infrastructure spending. That was what happened in 2009. They had big tax cuts and rebates and infrastructure spending. And that's something that both Republicans and Democrats agree on. And now none of them care about the deficit. It's $1 trillion and big deal. You haven't had a collapse in the economy. You haven't had sky-high interest rates. They've gotten callous to the idea of deficits. So I think we will have fiscal stimulus, but it takes time to be effective.
Okay.
In 2009, they had massive public works kind of spending. That's done at the federal government level, but it's spent at the state levels. And 3 years later, only 30% of that money allocated had actually been spent.
Right.
The states have to get all the zoning requirements and the contracts and build up the staffs and the contractors and so on. So I think we will have that, but it won't be effective. It may help confidence.
Right.
May help confidence, but in terms of actual spending, it probably would not have effects until well into the following recovery.
So that's my next question, which is, so if in fact we do fall into recession, if we're not in one already, and we do see a market correction, because you are short the S&P 500, you would hope that there would be a market correction. How long do you think the process will take to move out of a recession? And to your point, fiscal policy having a bit of an impact. Are we talking about a 5-year time horizon in terms of really low, slower growth?
Well, there's a lot of things that suggest that global slowing growth in years ahead. One is aging populations.
Yeah.
People don't spend as much money. Another one is that you have really, since the early 80s, had a big rush into consumer spending. People have been borrow-heavily spending. Now they're saving, and when you're spending, your income is growing slower than spending. When you're saving, it's the reverse. So I think there's a lot of indicators that suggest slower growth in the years ahead. Now, that does not mean the end of the world, and I happen to think productivity growth, which has picked up in the U.S., not in Canada, but I think it has picked up, and it will continue to be stronger in the years ahead. So I think we can have real GNP growth of 2 to 2.5%. That's higher than most people expect, but that's in the longer run.
Yeah.
In recovery, recession, if it's an average recession, it lasts about 3 or 4 quarters. You can get big ones where there's special factors like the subprime mortgage collapse that gave you this very deep recession, 2007, 2009. But ordinarily, and by the way, if you had the normal reaction of stocks, it would say that the S&P would drop probably maybe a couple hundred points below the low it reached in December 24th, Christmas Eve. In other words, it wouldn't be a dramatic collapse, but it still would be a decline from here because it has rallied considerably since then.
So just so I'm clear, what kind of contraction are you expecting to see in the S&P 500 from a percentage perspective?
Yeah, I think, and again, assuming it's sort of an average run-of-the-mill recession, U.S. declined 1.5% to 2% real GDP. Now that's different than the 3% type of decline with a Great Recession. Recessions are more a absence of growth than they are collapse. I mean, consumer spending, for example, we've had 13 recessions in the post-war period. In 6 of those, real inflation-adjusted consumer spending actually increased. 7 of them have declined, but it never declines by more than 1% or 2. But it's the absence of growth which is what bothers people. And you have other sectors of the economy which are obviously a lot weaker than the consumer.
So where do you think then the S&P 500 would drop to on a percentage basis, just based on an average recession?
Well, from here, it probably could go down another 15, 20%.
Okay.
And again, that would give it the average. The average decline in a post-war recessions, if you exclude the sort of special events like the subprime mortgage collapse, the S&P peak to trough declined 22%. So that's about where you would be.
And Gary, it's interesting to talk about the subprime mortgage market and the meltdown and how deep that impacted the U.S. and global economy. My goodness, all the various banks, global banks, and counterparty risks that were involved. Do you have, not maybe obviously the exact same concern, but talk to us about your view and what you're seeing in the repo market. Is that a concern in terms of the lack of liquidity that we're seeing in this overnight market?
Yeah, it's a very arcane area, Catherine. I tend to think that it is more a manage of the mechanics as opposed to anything deep-seated. There are a lot of, there's a lot of excess reserves there. They were created with quantitative easing, and the banks have been very cautious on that. They've been told to hang on to their money and so on and so forth. And so I think you had quarter-end tax payments and some special factors, and the Fed they were a little slow on the trigger, but I think they have woken up to that. And Powell made a speech today, and he's talking about more money. He said it isn't quantitative easing, but we're going to provide plenty of money. So I think they're really just saying that those issues are relatively short-term and not of great significance.
Is there any area within the system, however we want to define that you are concerned about? And one of the areas I wonder about is the private equity market, given the fact that these lower interest rates for so long have caused so many pension funds, family offices, money managers to move into that area, and still are, specifically almost even more so in the later side of this, the private credit market. Are you concerned?
Well, there are a number of factors there. Obviously, low interest rates are causing, shall we say, an agonizing reappraisal among financial institutions. So when you look at that, plus the pressure on fees, there's no question that the financial sector, if I were doing it over, I would not go into it today. I mean, I was lucky to be involved in it and benefited like almost everybody else in it. But it's a very different world today, and you have low fees. You have pressure on markets. You've got a problem with over about 50% of U.S. Corporate bonds are BBB, and that's only one step away from junk. You get a recession, a lot of them forced down, then you get cumulative downward spiral because a lot of financial institutions cannot own junk bonds.
Right.
So you do have a precarious situation there.
Okay. And just lastly, so the new news here from our discussion today is that you are going short the S&P 500. You have been long U.S. Treasuries, 30-year Treasuries since the 70s.
Yes,
it's closed at 2.031 on the yield, 30-year yield today. What do you do with the U.S. Treasury market
Well,
today?
we're still holding them. Now, my target was 2%, and I'm very aware from past experience of overstaying a winning position. I mean, I've been there, done that. But I do think there's probably still some further rally in long Treasuries, decline in yields, and because the U.S. is a safe haven, and if I'm right that we're in or close to a global recession, I think the lack of credit demand and the zeal for safety, I think we'll see some further rally. We have not liquidated our positions there in long Treasuries, just so put our money where our mouth is.
Okay, that's always great to do. Gary, nice to see you. Thank you for being in with us.
Delighted to be here, Catherine. It's always a pleasure.
Thank you so much. That is Gary Shilling, president of Gary Shilling & Company.